Okay, ladies and gentlemen, welcome back. Today I am going to be bringing you guys the Big Short, Mr. Legendary Trader himself of 2008, Michael Burry, and what he has done recently and how the market has reacted to it. You guys definitely don't want to miss this. Make sure you watch until the end of the video because there's a lot of great content here. And, well, we all want our dividend portfolios to grow. So, understanding how these things work is extremely important to that. So here we go. Michael Burry recently, actually, at first, let's talk about who Michael Burry is. So Michael Burry is basically managing what's referred to as Scion Asset Management Group. Mr. Burry is the guy that's responsible for shorting the 2008 subprime mortgage crash before it even took place. A lot of people say he actually got in early, and a lot of investors that had invested money with him were getting mad at him because they thought that the markets were just going to keep going up and they were going to lose their money. And if you guys know anything about shorting the market, if you short something, the loss potential is infinite. It's not like if you long something, then your cost basis goes to zero. You could actually lose more than your initial investment capital if you short something and it goes against you and you keep holding that short. So it's understandable why investors were freaked out about this. But over time, Michael Burry's short played out. For those of you guys who have seen the movie The Big Short with Christian Bale, you know what I'm talking about here. But this guy is legendary for his massive short trade, in which I think he made like $100 million net worth or something on the real estate crash back in 2008. So he's at it again. From the look of it, he actually just. I'm going to go ahead and scroll down here so you guys can see this. The firm just filed its F13F, which details its holdings as of the end of the second quarter, ended June 30th. It revealed big bets against the SPY and QQQ, which is the equivalent of the S&P 500 and the NASDAQ, for those of you that don't know, using put options worth a national 1.6 billion, again, guys, billion with a B, dollar value. And here's what it could mean. So they go into all this information. I will go ahead and leave the link down below so you guys can read this for yourself if you're interested. Again, it states here, his investors thought the play was reckless and he endured vicious criticism up until it eventually paid off when the housing market crashed in 2008. Burry took home an estimated $100 million and Scion's investors pocketed a whopping $700 million. So he got in early and ultimately the market ended up crashing. And I'm going to explain why this is so significant to dividend investors and anybody who's involved in the markets here in a minute. So here's another link that I'll leave in the video. It describes who the Big Short investor is, known for predicting basically huge market crashes. He's pretty much a bear who has infinite patience and is willing to wait for the market to give like massive red flag warnings to just dump on everybody, and that's when he loads the boat on all these short positions. And well, he was right in 2008, so a lot of people that invest are probably taking this pretty seriously, I can imagine. I myself am too, which is why I'm making a video on it. So if we go over here to whalewisdom.com, again, I'll leave this in the link so you can look at it. You can see that this is all of their current holdings as of their most recent 13F filing in quarter one owned. So basically, I'm not really sure exactly what this means. They either owned the shares in Q1 and it was reported in Q2, or they own them in Q2 and it was reported in Q2. I'm not really sure which, but from what you guys can see here, I mean, this is an insane amount of money, guys. This is $1.6 billion. He has puts of 2 million option puts on both the SPY and the QQQ. Now, I don't know a whole lot about options personally. I plan on starting to learn in October, but what I will tell you about options is I understand this much. Okay, calls are for options traders that expect prices of the underlying security to go up, or in this case, an index, I guess it would be. And puts are meant for traders, investors who expect the price of whatever it is they're placing a put on to go down. This dude has put probably the lion's share of their capital on the line to short this market currently. This is a big deal. So, what does it mean for dividend investors and for investors who are looking to make profit and or passive income? Well, I can tell you guys right here, when the prices went all the way down here from the January 2022 peak at 4,800 on the SPY down to 3,500 at the bottom at October 2022 when it was at 3,500, which is a humongous drop of about 27%. That's a big drop for the S&P. A correction is considered to be between 5 to 10%. That's a normal pullback that happens maybe once or twice a year, so you can understand just how significant that move was. A lot of these stocks were at absolutely dirt cheap rock bottom prices, and I'm going to take a look at a couple here that you guys can actually see. So let's take a look at Tesla. I know Tesla is not technically a dividend paying stock, but from what you can see, Tesla was around $170 a share at roughly the bottom of the S&P drop. So that was about a 58% drop on that. You take a look at maybe something like, trying to think of what might be another good play here that maybe had some massive downside. Okay, so maybe not Coca-Cola. Take a look at maybe something like, hold on, let me scroll through this list real quick, see if I can find something here that you guys can look at. So, okay, so we'll take a look at 3M as an example. That would probably be a pretty good one right there. So, aside from the legal litigations that 3M is having, as you guys can see here, 3M from its peak right before the market peaked out was at about $211 a share. And in October, it was right around $125 to $111 a share. So about a 40 to 45% drop. So in terms of dividends and how this works, when the share prices of these companies go down, the dividend yield of the company goes up. Okay. So 3M's dividend currently is at about 6%. If it was all the way up here, it would only be about 3%. So what does that mean in terms of buying dividend paying stocks and how you can stretch your money further to create more passive income with the same capital or even less capital? So the price and the yield are inversely correlated. If the shares are high, the yield's going to be low. And if the shares are low, the yield's going to be high. So if I wanted to put $100 into this thing when it was at $107 a share, I'd get about one share of it. If I wanted to put $100 into this thing at $200 a share, I'd only get half a share, which means I would get about half of the yield at the top. So if I want to put $200 a share into 3M at the bottom here, I'd get 2 shares, which means twice as much passive income, and I would only get 1 share up here. So my money would have half of the purchasing power in terms of producing passive income. Now, Michael Burry was not wrong back in 2008. He eventually ended up being right. The Fed meeting minutes just came out today. They pretty much stated that they intend to possibly raise more rates, maybe keep them higher for longer. They sounded pretty hawkish during the meeting minutes, which means that the longer that they keep the rates up, the more it crushes demand and slows down the economy, and then these companies have less capital to work with. They have to tighten up on their capital expenditures, and stocks go down, and that's typically how it works. So Michael Burry is kind of predicting, by putting his money where his mouth is, he's predicting this huge crash to come. So in short, guys, if the crash comes, me personally, I'm going to tell you right now what I'm doing. I'm not giving financial advice here, but what I would do if a crash were to come is I would have a set amount of cash on the side to make sure that I could DCA into the crash, because there's no telling how long it could be. And I would be DCAing into positions that provide either great capital return or great passive income along the way that mounts up over time, and I would be reinvesting the dividends that I got paid every month and a set portion of my capital on the side or income on the side, while still maintaining that certain cash amount throughout the entire time. That's what I would do. So if you guys want to build more passive income along the way and the market crashes, the market is a perfect opportunity to buy a lot of these stocks or ETFs or funds or REITs or whatever it is you're into, yield max funds, clip, so on and so on, or growth stocks like Tesla, with the potential to make absolutely astronomical passive income and or gains along the way. This is another potential black swan event that could actually end up leading the markets to sell off. Is it going to sell off? Honestly, I don't think that's very likely that we're going to see a humongous crash. If we do, we're probably not going to see it this year. I'll reiterate one more time what my expectations are for the S&P 500 going forward. August and September, as you know, is the most bearish times of the year. Historically speaking, for the last 50 years, the most bearish months in the year for the stock market has always been August and September. So here's kind of what my expectations are. Ever since we hit 4,600 from a technical perspective, from what you guys can see here, we've sold off. So we've sold off for 3 weeks straight. Again, seasonality is pretty standard for the markets during August and September. I expect to pull back to as much as 43.51 at the absolute lowest. If I were to be really generous here and say we're going to pull back even further than that, I would say maybe we might pull back all the way here down to 42.50 and then head higher from there, which lines up almost perfectly with this previous resistance turn support. I don't expect us to go lower than that, but you never know. Things happen. I mean, the CV dump happened and nobody saw that coming, right? So anyways, hope this was helpful. Hope you guys enjoyed this video. It was a little bit longer because there's a lot for me to explain in here. Investing is about a lot more than just collecting dividends. Dividends is one very small fragmentation of the overall investing community. So anyways, I got to go. Y'all have a great day and a great weekend. And please comment, rate, and subscribe. I will see y'all later. Peace.